So now it sounds different. So there's a huge variety of users from the asset managers, hedge funds, to the super low latency traders, and it's kind of interesting to look at the different business models, because the hedge funds, for them they have some long-term prediction that Nvidia will go to whatever price, and so when they buy a share, they expect to make money on holding the position, right? And for them, getting into the position is a cost, right? Whereas for the market makers, it's the other way around, right? For them, money scales with the volume they do, and usually the longer you hold a position, the worse it gets, right? And so the asset managers, they focus on these complex alphas, balance sheets, analyst consensus, earnings predictions. I have these complex models, right, where on HFT, your primary focus is tech, right? Software, hardware, FPGAs, and maybe or maybe not even ASICs. You spend a lot of money on feed lines, order lines, and it's really astonishing where the industry has gotten to. We are now, so last year the state of the art was 5 nanos reaction times, and I had predicted this would be about the asymptotic limit, but it turns out I was wrong. Right? So it's gone further than that since. So they have some very different needs, and so I have slides for both use cases, but I'll probably only get to the first one. So the long end, right? So imagine, right, you are asset manager, hedge fund, and you have some historical model prediction, and now your challenge is, how do I backtest my strategy? Kind of a popular execution mechanism is just execute in the closing auction and be done with it. You have limited impact. There's a lot of liquidity, and it's easy. Now, the annoying thing about Xetra is that the book in the closing auction is dark, right? So you don't see the book. All you get is after the auction ends, you see the uncrossing price, and you see the total volume traded. But it's very hard for you to predict, right? If I had an additional order in the book, right, would that have been executed, and would I have moved the price? So the auctions are a surprisingly significant part of the market, despite the fact that they only take 5 plus X minutes. 25% or so of the total volume is traded only in the closing auction. Let me see. There are some participants virtually only do the closing auction, and there's an edge case. There's a narrow range where you can predict the outcome of the auction, but it's not really usable. So I believe, actually, I think the one on the left is kind of an animation. Could someone click on this, maybe? Is this possible? But it's not mission critical. Okay. And then pause maybe immediately, huh? So, anytime, if you hit pause, that's fine. But it's not mission critical. I had expected to be in the driving seat, but doesn't matter, huh? But could you just pause, please? All right. So what's going on here is, so the book is dark, right? All you see is the two black lines. You see here the vertical black line shows you the uncrossing price, and the horizontal line shows you the matched volume. But how this comes about, right? You don't see, right? So, but underneath, right, the exchange, right? We see here the full order book. So the red ones is the cumulative sell orders, and the green one is the buy volume, right? But And then here, this little added order here, this is kind of a hypothetical additional order, right? And it shows you how this additional order would have changed the outcome of the auction, right? And so this depends on the price, but it also depends on this order's priority, right? When you would have submitted the order, right? And so here in this, at this particular point where we paused, you see here, part of the order would have been filled, and the other, and the remainder would have remained unfilled. And you see the difference between the solid vertical line and the dashed vertical line. That's the market impact you would have had, right? And you don't have the underlying data, right, to compute this, but we have, right? And we would like to make this available to the market, to make better research, to backtest strategies, because at the end of the day, we want you to trade with us in the auction. So your normal approach, right, in the absence of this book data, would have been, you might have some calibration curve, either from your own production data or from some, maybe from some exchanges where the order book is lit, right? Or maybe from some exchange publications like this particular one, right? So here, for example, if you focus on the leftmost panel, right, on the horizontal axis, you see the size of a hypothetical additional order in terms of the average daily volume of the previous 20 days, and the vertical axis is your impact in basis points, right? So in this, right, for example, you would see if I put an additional 1% ADV into the closing auction, I would have moved the price by 3 basis points and change, right? So, but if you do this, you kind of miss the instrument-specific variations, you miss the day-to-day variations, and so we think you can and should do better. Right. All right. So this is a nice tie into Sven's presentation. So this will be so we'll make an interface available on A7, which lets you interact with the auction order book. Right? So internally, we know the order book, and we allow you to give us an additional hypothetical order, and then we do the T7 uncrossing logic, and we return you. This is the modified uncrossing price, and whether or not or how much of your hypothetical order would have been filled. So there is the potential danger of some information leakage, right? Because possibly asset managers, when they have a big position to fill, they might not do this on a single day, but might do this over the course of multiple days. So we have an index-specific delay, right? So for the DAX, it's basically a non-issue. You will be able to do this T+1, but then for the small caps, for the SDAX constituents, there will be a 5-day delay, and there will be a GUI, and there will be an API access. And now I got locked out of my screen again. So, and I think this would be a good point for the demo. So maybe first an explanation. So what you will be able to do on the platform, right? Right. You can pick a date, you can pick an instrument, which auction you want to simulate, and then it will return you here the original uncrossing price, the matched volume, and after you enter a simulated order, you will also see the modified uncrossing price and the outcome of your individual order. So let me show you this in action. Could you switch to my screen? All right. Okay. So hold on. So here we have the Xetra auctions. So this is still a dev deployment, and there are a couple of features that will not make it into production. Just as an aside, right? For example, the reason for the tick ladder is because the uncrossing logic is ridiculously complex in these edge cases. Where sometimes when you have a change in the tick size among multiple ambiguous uncrossing prices, then it gets really hairy. But we try to do this correctly. So you pick a date. Let's pick the 31st. You pick an instrument. Here, Deutsche Börse, to not show any bias. Right, and then here, is my mouse visible? Okay, right here now you have the historical data, the historical uncrossing price, and the total volume matched in the auction. Right, and here in the GUI, here now you can have an additional order, and let's say we do a buy order at 100. What do we say? Let's do this a bit. So fairly aggressive, and let's say we buy say 40,000 shares, right? And now you see here now it shows you the uncrossing price if your additional order is also in the order book, and you see here it has changed a little bit from .2 to a spot 45. And also the total crossed, the total matched volume has changed. Well, actually, I think in this particular one we don't show you the outcome of your order, but I'll show you the API, how this looks in the API. So I first need to generate a key for me. Because everything has to be secure. Need to authorize myself. All right. So, for example, let's pick the one with the symbol. All right. So we have so this API is so this element on the GUI is kind of to try out the different API syntaxes. All right. So we add an order. We can specify when we would have submitted the order, and what did we say? 10,000 lots, 10,000 orders. Right, and then we can hit execute, right? And so what you get back, I need a price. I need a site, obviously. That makes sense. All right, let's see. Yeah, okay. So, and this is, when you access the API, this is what you would get back. You see here the global parameters, uncrossing price, the simulated uncrossing price, and the volumes. And here you also see the outcome of your order. You see here the full 10,000 would have traded, and the price at which you got the price of your order. You obviously get filled at the uncrossing price. And so I have used actually this particular API for a use case. Can we switch back to the presentation? Right. So suppose you're a big, Bavaria-based car manufacturer, and you have a big share buyback program that you've announced for, I think 2 billion euros, and all public data, by the way. So this big car manufacturer publishes every single trade by venue, price, time, everything. Right, so now suppose you want, and everything is executed in the intraday, nothing in the auction at the moment. Now suppose you wonder, what if I just put everything I executed over the day into the closing auction? Right, would that have been better or worse? Right, and so if you do this, right, if you take the historical uncrossing price, you'll get the dark blue curve, right, and it looks like this would actually be better by 5.5 basis points. By the way, I have a little asterisk afterwards. Right. However, right, if you take into account the the market impact, right? So using this API, how much you would have moved the price, then you get the light blue curve. So, and it turns out that under this assumption, you would have actually been 7 basis points worse than what you actually did historically. Now, a bit of a caveat, because in a sense, right, for this light blue curve, right, you kind of use the same market impact twice, right? Because historically, right, you did the trading, right? So you moved the price a little bit, and then you simulate it again in the auction, right? So in reality, right, if you remove the intraday trading, the difference would be probably quite a bit less, right? But maybe we can change the question. Maybe you simulated, what if I traded twice as much, right, as I did? Right? Then you would get this would have cost me an additional 7 basis points, right? If this is much or not, right, I can't tell. So what other use cases are there? Right, as I showed, right, for example, you could compare your current intraday executions to a hypothetical closing auction only, right? You could backtest strategies, right? If you have some, setup type strategies, and what if I had executed those in the auctions historically, right? How much slippage would I have encountered? If I have an existing strategy, right? How much scaling potential is there, right? What if I traded twice as much, right? Twice the size than I currently do? You can also check if your order submissions, right, are optimal, right? Maybe I'm not getting filled because I'm too far back in the queue, right? Maybe if I submitted my orders early in the auction or even before the auction, right? Maybe then I would get better filled, right? So all this will be possible with this new API, and you can do this back historically to April 2019. I believe this is when our history starts. And I believe, so it's a bit too much time to kind of start on the next one, right? If there is a question, right, or more than one, I'd be happy to entertain them. Otherwise, right, I'll talk about the evil HFTs.
Stefan, I've got a question for you.
Yeah.
So this relates to simulated orders, right? Can simulated orders trigger or else prevent volatility?
Now we're getting down into the brushwork. So when we developed this, there's a lot of edge cases, right? So for example, so if in the historical data, suppose there was a scheduled auction and there was a volatility extension, right? Because the uncrossing price might have been outside of the volatility band, right? So then in this case, your simulated orders do not move kind of the uncrossing point in time, right? So for example, right, you can simulate an order for 20 million shares, right? It will do the uncrossing logic and not trigger volatility auction. We thought this would be a bit over-engineering, so buyer beware. On the other hand, if in the historical data there was a volatility extension, right? So we always take the book at the time of the uncross, right? So including the volatility extension. So theoretically, you could have a simulated order that would have prevented the volatility extension, right? This will also not happen, right? So we always assume the nanosecond before the auction ends, you magically enter the order potentially in the middle of the queue, and brute force do the uncrossing. No prisoners. Then let's go to the dark side. Let's see. So ironically, right, there are a couple of different latencies if you think about it. There's some strategies are pure reaction time, so something happens on Xetra or Eurex, and you react by sending an order again to Eurex or Xetra. So kind of these internal triggered strategies, and this is where we see the 5 or less nanosecond reaction times. Right? But another avenue to gain a speed is get data from other venues. Right? So for example, you use CME data to trade in Europe or from Asia. And since we now have CME data on A7, right, that gives me the possibility to also play with it. Right? So there's a positive side effect. So and one relatively recent advance, right, in quotes, is that someone figured out that you can send information, right, via the classical old school shortwave radio, right, and this gains you 9 milliseconds in latency, purely due to the fact that your signal travels through air, and the speed of light in air is faster than in the fiber that you would have to take across the Atlantic, and so 9 milliseconds is a long time, right, when you're normally dealing with nanos, right? So, and let's skip this right. And so what we see here is, so the vertical axis is the date starting 2017, and then 2023 here towards the bottom, and the horizontal axis is a latency measured between a trade on CME to a trade on Eurex, right? So the left one is trade to trade, and the right one is trade to a quote, right? And we see, right, until about early 2020, right, most of these reactions came here at 36 or so millis, and that's exactly the time that you need to go Chicago, microwave, East Coast, fiber through the Atlantic to Wales, and then microwave to Frankfurt. That gives you the 36 or so millis. And then starting here early 2020, we see the first reactions here kicking in earlier. And the dotted line is kind of the best case for shortwave. And we now see over the last 1 or 2 years that a lot of volume and quoting activity uses these. So this particular plot is for the S&P 500 future on the CME being used to trade the DAX future on Eurex, but the plot for other pairs looks very similar. Right? I also looked at a fixed income future to trade a European fixed income future. They look very similar. Right? And also, by the way, in the opposite direction, there's very little going on. So the US markets don't care much about what happens in Europe, with the exception maybe when the US is still closed and we are open. But even then, not much. So, and by the way, right, so this chart, by the way, is also purely based on hitting the A7 API for the data and doing some pre-processing there. Right, and so we can also look at this intraday, which shows you what I mentioned before here. Right, see, yeah, so nothing happens, right, and then you see the US cash open, and then suddenly all the reactions start. There's a couple sharp bands around the US economic events, non-farm payrolls, central bank announcements, and what's the other one? FOMC, and around the cash close. That it's nothing before, nothing after. Right. By the way, eco US is the only Bloomberg command I know. So in this, no, I think I want to skip this here.